We want to bring in Mohamed El-Erian. He's chief economic advisor at Allianz. He's also the president of Queen's College at Cambridge University. And Mohamed, how much is riding on this number today?
A lot. You know, after last month's harder than expected number, people are nervous. They're hoping that last month was a fluke. Remember what happened last month? When the release came out, stocks sold off, yields went up, and people really changed the expectation of rate cuts this year, and even had people talk about a rate hike. So the hope is that this month we will establish that last month was a fluke. But I think there's a bigger picture, and that was picked up yesterday by the New York Fed Inflationary Expectation Survey, and that is inflation expectations are stuck just under 3%. And that's, I think, is our reality for a while.
Those inflation expectations, that's a leading indicator?
It is. It's ask people, what do you expect for the next year? What do you expect for the next 3 years? And what do you expect for the next 5 years? And the next year is 3%. And then when you go to 3 to 5 years, it's 2.7 to 2.9%. So still far away from what people tend to think of the Fed's inflation target, even though that inflation target is applicable to another measure.
If the number is hotter than anticipated, what does that mean for the Fed's possibility of rate cuts in June, which is kind of what the impression we got from Jay Powell the last time he spoke last week? Just this idea that they're ready to cut and they think that time is coming sooner rather than later.
Yeah, you know, unlike the market that's been on a roller coaster, we were pricing in as many as 7 cuts, then 2 cuts. Now we're at 4 cuts. We were pricing in at one time March. Now we are June. The Fed has held a steady course. 3 cuts most likely starting in June, and that was reaffirmed by Chair Powell. And I think, Becky, that is the right outlook. That is what I think should happen given the economy that we are living in today.
Even if that inflation number comes in hotter than anticipated, you don't think that'll push things off? Because Jamie Dimon, speaking yesterday, said he thinks maybe the Fed shouldn't cut in June, maybe wait and see how the numbers go and give themselves a little room. He actually suggested that the Fed's credibility is at risk if they cut too soon.
Yeah, or they can stay too tight for too long, and then the credibility will be at risk there. Look, all this has a critical issue. What do you think is the right underlying inflation rate? Or what economists call the neutral interest rates? What do you think is the equilibrium rate? If you think the equilibrium rate is 2%, that's what the Fed should be targeting in terms of inflation, then they should hold off. If, like me, you believe that we are living in a world where supply is insufficiently flexible and that you should aim higher than 2%, tolerate more than 2% for a while, 2.5 to 3, then we are restrictive and they should cut. So all these discussions lead back to something that people don't like talking about, which is what is the right inflation target for the world we live in today?
And what do you think it is?
I think it's around 2.5 to 3. I think the biggest likely error is that the Fed gets too data dependent, continues to be too data dependent, focuses only on 2%, and in the process sacrifices what has been an exceptional economy that has outpaced all the other economies in the world.
Too data dependent because you think the data is wrong or outdated?
I think that, first of all, I think the data is lagged and their tools act with a lag to the future. So think of driving a car looking at the rearview mirror. If all you do is look at the rearview mirror, if you're completely data dependent, then you will likely crash. If, however, the rearview mirror informs you, but you're looking forward, that's a different way of policymaking.
So you think
the Fed got burned.
Oh, go ahead.
The Fed got totally burned. Inflation went all the way up to 9%. They had dismissed it as transitory, and because of that, they are now overly dependent on the data. And I think that at some point they've got to transition to a broader view of the economy.
Steve Leisman was just pointing out in the last hour how the housing numbers that's the most stubborn part of the inflation data that's been here. that they may at some point say, forget it, we're not going to be paying attention to this because we think it's basically flawed data?
Yeah, and there's good reason for that. You know, we now all become experts on OER, single family, multifamily, what are the weights between the two, and there's a lot going on there. And it is the owner equivalent rent that caused the inflation numbers to be hotter than what was expected last month. I don't think you can ignore it totally, but I do think that the Fed will see through a lot of it, as Steve said.
So if this number is hotter today, you would say take that with a grain of salt, too, even though it would be 2 months in a row of higher inflation coming in on the CPI number?
I would say understand that because of what's happening on the supply side and what's going to continue to happen on the supply side, we're going to live in a world where inflation is nearer to 3% than 2%. It is not the end of the world. The economy is functioning well. People have adjusted. We will ultimately go lower. But if we force it, Becky, that's what I'm worried about. If we force it, then this is what will result. We will push the economy into recession, unduly so. This economy doesn't need into recession. And we may cause more financial accidents. So, you know, at the end of the day, there's a judgment to be made here as to what is the new equilibrium inflation rate. And I suspect that the numbers will keep on telling us, as yesterday's number from the New York Fed did, that it is higher than the 2%.